Hello, I'm Dustin Padgett, Division President at Big Sioux Wealth Management. It has been some time since we have been seeing this amount of nervousness among our client base. In fact, not since the 2020 presidential election have we seen so many of our clients this worried about the markets. Despite investor anxiety surrounding the 2020 presidential election, the markets went on to have a great run, lasting through the end of 2021. Since the beginning of the new year, equity and bond markets have dropped, and market volatility is seemingly picking up again. Giving investors heightened nerves, we thought it would be a good time to check in. As we prepared for the year 2022 and considered what the new year might bring for investors, several key themes appeared. Today, those themes appear to be playing out. Increased volatility. Given the run stocks have had since March of 2020, the COVID lows, to the end of 2021, we viewed it as very likely stocks would experience a 10 to 20% drop at some point in 2022. After all, on average, the stock market declines 10% or more once per year. The first half of 2022 was also an area of interest, as we expected the Federal Reserve to provide clarification as to when they might start raising rates. Since the beginning of the 2022 year, we have seen hotter than expected inflation numbers. In turn, the market seemed to be pricing in additional rate hikes and signaling that the hikes may occur sooner rather than later. The Federal Reserve also indicated that they may reduce the size of their balance sheet. Additional interest rate hike expectations, paired with the Fed's apparent intent to begin quantitative tightening, has led to a decline in the stock and bond markets. With interest rates largely dropping since the 1980s, a sustained rising interest rate environment could lead to major changes, particularly in the bond markets. With increased volatility comes more ups and downs. This leads us to our second theme: buy the dip, sell the rips. We have been very fortunate the last 5 years, being blessed with unusually good markets. Investors have been rewarded for buying and holding investments. We expect this year to be somewhat different, which may lead to more active trading being rewarded. While we do consider ourselves long-term investors, we may try to capitalize on some shorter-term opportunities in client portfolios. We are managing your investment account. You may see more trades in your account than you have seen in the past. If you have met with us recently for a portfolio review, we likely mentioned that we are not expecting the same type of returns we have seen in the past 5 years. We believe market returns tend to revert to their mean. Considering how high investment returns have been over the last 5 years compared to their historical average, this leads us to believe that returns may not be as good in the coming 5 years. Even my family must sometimes be reminded that the stock market has ups and downs. Last October, after reviewing our monthly statement, my wife came to me and said, "Hey, we lost money this month." I smiled and said, "Investors tend to have a recency bias. It is not normal for every statement balance to be higher than the last." I also reminded her that we had not locked in the loss unless we have sold. And we can be certain that there will be more down statements in the future. Volatility is the price investors pay for potential of higher long-term returns. Stocks have largely been falling since the beginning of the year as investors continue to be concerned with the impact of high inflation and upcoming interest rate hikes by the Federal Reserve. The Russia-Ukraine conflict has only exacerbated investor worries. While generally we stay away from making political comments, many investors now fear the new sanctions on Russia could cause prices of oil, food, and other commodities to increase further. This concern, along with inflation fears and rate hike uncertainty, contributed to the S&P 500 hitting an intraday low February 24th of 4,114 points. This mark was 14.6% below the index's all-time high of 4818. When market drops more than 10%, it's generally defined as a correction. Over the years, I have used corrections as opportunities to add money to my investments. After all, lower prices mean I can buy while there is a sale. While we don't expect the remainder of 2022 to be a smooth ride, we do not expect doomsday either. Many investors find themselves with high checking and savings account balances because they are nervous to invest after the markets have already gone up. This can be frustrating as bank accounts are yielding very little and inflation continues to reduce the value of hard-earned dollars. While it is impossible to know when the bottom of a stock market drop will occur, we feel investing during corrections can be a good way to invest at a discount. Whether you should invest new money now depends on your unique situation, but we encourage you to contact us if you would like to discuss whether investing new money may be appropriate for you. While our portfolios have very little exposure to Russia, the more important point is that 44 million innocent people in Ukraine are facing an unprovoked invasion from Russia. Our thoughts and prayers are with them. In summary, rather than fearing the market volatility, we plan to use it to our advantage. Money can invoke many good and bad emotions, but investors who can control their emotions often end up with superior returns. Rather than getting caught up in the news headlines and allowing your emotions to take over your decision making, we encourage you to think long term and use the situation to your advantage. If your bank account balances are too high, we invite you to give us a call to discuss whether buying the dip is appropriate for you. If you have any questions or would simply like to discuss the markets, we invite you to call us.